A crypto investor's guide to the world of on-chain analytics and market mechanics. I want to start with a feeling, not a chart, not a metric, a feeling. You're sitting there looking at your portfolio and it's red again. And the frustrating part, the part that keeps you up at night, is that you did everything right. It isn't just the money, you actually put in the work. You researched the project, you looked into the team, you understood the tokenomics. You were patient, you didn't ape in, you waited the perfect entry. Yet, you still got it wrong. And in that moment, if you're honest with yourself, you know there's a voice in your head that starts to creep in. Maybe I'm not cut out for this. Maybe there's something I'm missing. Maybe I'm never going to win. Perhaps the people making real money in crypto know something that I don't. Maybe there's a level to the game that I don't quite understand. I'm here to tell you that that feeling is not a signal that you're not cut out for crypto, but there absolutely is a level to the game that I'm confident you're not tapping into yet. And that's what today's video is all about. Here's what nobody tells you when you're starting out. Price is the last thing to tell you the truth. By the time a move shows up on the chart, there's an incredible amount of activity that's taken place under the hood. And the investors who saw it coming were the ones who actually made money. While you were looking at candles, they were looking at the data underneath them. I'm assuming most people watching this video understand what a blockchain is. But for those less informed, a blockchain is basically a ledger that tracks everything. It records everything. All public, all free, there forever. Those who know how to read the data within the blockchain are those who come out ahead time and time again. I have over 9 years of experience in the space. I built a team with over 50 years of combined experience, and we have over 1 million investors worldwide who follow our research. So trust me when I tell you the key to outperforming the market is to get under the hood and start to understand the data within the blockchain itself. Understanding the blockchain is the key. Who's holding? When did they buy? Are they in profit or at a loss? Are institutions buying? Are traders over leveraged or are they scared? All of this can be found within the blockchain. It's not locked behind a Bloomberg terminal. It's not behind some super expensive subscription. It's not only available for hedge funds. Every single one of us has access to it for free. So why is nobody bothering to tap into it? My name is Adam. I'm one of the co-founders of Cryptonary, and me and my team have been analyzing on-chain data and market mechanics for nearly 9 years. We were writing about capitulation signals in summer 2022, weeks before the bottom came in. We flagged the late bull distribution pattern when everyone else was screaming the cycle top was months away. And the track record that comes from that experience with Sol, Hype, Ethereum, that's not a fluke. That's a framework being applied consistently time and time again across multiple cycles. By the end of this video, you're going to understand the 3 most important cohorts of data that drive the crypto markets. Cost basis, profit and loss, and flows. You're going to understand what each metric is telling you and how they can be put together into a single picture to help you apply it to the market. And the next time the market does something that blindsides everyone, you will have been prepared. You're going to know exactly what's happening and why. And that's not a promise. That's just what happens when you actually understand the data. So what is on-chain data and why do most people ignore it? Every public blockchain is a permanent, transparent, free ledger that anyone can access. Every transaction that has ever happened, every swap, every trade, every single move from wallet to wallet, all of it is there, accessible to you. It's not hidden, it's not proprietary, yet no one taps into this. Unlike traditional finance, there's no excuse for accessibility. The reasoning why people skip past this is because it's difficult, because it's complicated, because it requires effort. And unfortunately, most of the content in the crypto space is geared around tips, hacks, and quick fixes. What you actually need to win in this game is a macro foundation, a technical understanding, and the ability to read on-chain data and market mechanics and apply that to your trading and investing. We have a full masterclass on macro, we have a 14-minute deep dive on TA, and today we put together a full breakdown, mechanics, and on-chain. In my opinion, market mechanics is often the missing ingredient between what separates good traders from great traders and bad investors from good investors. Look, in TradFi, you can't see this. It's an unfair game. It's absolutely rigged. You can see a stock price, you can see the volume, but do you know the average price in which different types of investors actually bought? Do you know if they're in a profit or a loss? Do you know every single transaction they're placing? No, and that's why you can't win in traditional finance. This information is locked behind $20,000 Bloomberg terminals or $10,000 data subscriptions. That's why in traditional finance, 99% of investors and traders fall short. And that's the reason I choose to put my time into crypto, not TradFi. There are hundreds of on-chain data points and metrics that you could go over. In today's video, we're going to go over the ones that we at Cryptonary use every single week as part of our market updates and research reports. These are the same metrics that have allowed us to consistently outperform the market time and time again since 2017. This video is structured into 3 parts, and together they'll paint a picture to help you understand the world of on-chain and mechanics. First, cost basis. Where did people buy? Second, profit and loss. How are people responding to it? Third, flows data. What is happening beneath the surface? 3 cohorts, 4 metrics each, 12 metrics total, 1 complete picture. Let's get into it. Let's start with cost basis. Cost basis is simply where someone bought. This can be looked at an individual level, a cohort level, or the full picture. Let's start with cost basis. Cost basis is simply where someone bought. However, with on-chain, we don't just look at this from an individual level. We don't just look at this from a cohort level. We can calculate aggregate cost basis for the entire market and specific groups within it. And that changes everything because price doesn't move in isolation. Price exists relative to where someone bought or sold. And when you understand where people bought, you're a lot more likely to get an idea of where they're likely to sell. If Bitcoin drops from $100,000 to $60,000, that's awful, right? You're probably going to panic. But if someone got in at $1,000, he's probably not too worried. Both people experience the same thing, a drop from $100,000 to $60,000, but their reactions will be very, very different based off where they bought. On-chain gives us a lens to how people are likely to act before they do based off where they bought. The first metric, and probably the most important in all of on-chain, is called realized price. The simplest way to understand realized price is to picture this. Imagine you can look at the price every single house was purchased at in a country. Not the current market value, the actual price houses were purchased at the last time they were bought. You add all of those up, weigh them across the houses, and you have the average cost basis level for the entire property market. That's realized price. Every coin has a cost basis. It's priced when it last moved. Aggregate those across the entire supply and you get the realized price. This can also be seen as the average price at which the collective market is sitting. Across every major cycle I've watched, when price falls near or below realized price, buyers step in hard. Because at realized price, the average holder is at break even. The market finds that level very, very appealing because these people are very unlikely to sell. So it makes sense as an entry point. And when an entry makes sense, people are likely to get in, meaning price goes up. When the actual price is well above realized price, it means that people are very, very profitable. The question becomes, how profitable do these people need to become before they decide it's time to sell? The higher it goes, the more sell pressure builds. And the higher the sell pressure, the bigger chance we get that things are about to pull back. There's a refinement of realized price called the true market mean. And this essentially strips away all the dormant tokens in the market. If a wallet hasn't done something since 2010, it's probably not going to do anything now. So by removing those, you're left with the cost basis of the active market. Now, there are no guarantees that these old wallets won't become active and these old tokens won't be moved. So what you're left with is a range instead of a singular level. That range is very, very important. Okay, now we're going to look at market value versus realized value, also known as MVRV. MVRV is the ratio of current market cap to realized cap. It tells you how expensive or cheap the market is is relative to where everyone actually bought. A high MVRV, something like 3 plus across prior cycles, suggests that the market is extended. The average person is in high profit, which means they're a lot more likely to sell. This is often where tops tend to form. And the opposite is true. When MVRV is a lot lower, perhaps sub 1, means a lot of people underwater. And it gives a great opportunity for people to buy. Because in the most circumstances, people psychologically do not want to sell at a loss. Of course, forced selling is often a riskier, but time and time again, this seems to be a great entry point across multiple cycles. So while most people are looking at price and asking, is this a good time to buy? MVRV answers a much better question. Relative to where everyone bought, are we expensive or are we cheap? Next up, we have electrical and production costs. This metric shifts us to the supply side of the market. So instead of looking at buyers and holders, we're looking at the suppliers. In this case, we look at miners, and miners matter a whole lot more than you might think. The electrical cost is the pure energy cost for mining Bitcoin, and the production cost accounts for the hardware such as computers, rigs, etc. You can look at this as the all-in cost it takes to produce a singular token. Here's a key insight. Miners are essentially structured sellers. If the price of Bitcoin drops below the cost of production, they're forced to sell because they have to cover costs and pay bills in fiat. You can't pay your electric bill in Bitcoin, so you have to cash out so you can buy the electricity to continue. So the lower Bitcoin's price falls in relation to the cost of producing one means there's more sell pressure building. These miners have to sell to cover costs. In many cases, miners are forced to sell at a loss, and in few cases, but it does happen, they actually have to close up shop. But across my experience in the market, and when we look at multiple cycles, when production costs and price line up, this tends to be a phenomenal entry zone most of the time. These minor capitulation events where price crashes through production costs have time and time again presented phenomenal opportunities and tends to signal the bottom or very close to it, because ultimately it's unsustainable to continue producing Bitcoin if you're below the cost of production. New supply creation has become uneconomical and buyers are forced to step in. When price approaches minor cost level, you're not getting a buy signal, but you are getting a marker that tells you we're entering a genuinely distressed territory, and distressed territory is where patient investors win. Now we move on to short-term holders and long-term holders. On chain, every wallet is categorized based on how long it holds onto its tokens. You are considered a short-term holder if you've moved a token within the last 155 days, and you're considered a long-term holder if you haven't moved a token the last 155 days. These two groups of people are psychologically very, very different, and understanding the difference in the psychology between these two types of people is probably one of the most useful things you can walk away with from this masterclass. Short-term holders are reactive. They bought recently, their cost basis reflects current market conditions, and when price drops below short-term holder costs, they're a lot more likely to sell. Whereas someone who's been holding for a longer time is more rugged. They're more familiar with the market. A 20% decrease doesn't throw them off. They probably bought a whole lot longer ago, and whether they bought higher or lower, they clearly haven't been affected. They haven't done anything in 5+ months, so they're probably not going to react from short-term price swings. When you see these long-term holders buying, that's an incredibly bullish sign for the broader picture. Now, within this, each group has their own MVRV. When we see the MVRV of short-term holders being deeply negative, it means that these recent buyers are at a significant loss. The market's very fragile, as these guys are a lot more likely to sell. This can often lead to a capitulation or a relief bounce likely coming. When we look at the MVRV of long-term holders, if we see historical highs, long-term holders are sitting on an enormous amount of unrealized gains. The question becomes, when do they decide it's time to start selling and making some money? This is usually a great signal for understanding if we're at a late bull market point. If you're able to read these two things together, you stop asking, is the market bullish or bearish? And you start asking, which group is in control and where are we likely headed to next? Now, let's move on to section 2, profit and loss. You now know where people bought. Now you need to understand what they're going to do about it. We looked at the difference between behavior based on the different type of investor. But now the same investor will act completely differently whether he's 40% up or 40% down. These fear and greed concepts are not abstract. They're measurable thanks to on-chain data. And when you start to measure, you can start to anticipate what comes next. First, let's look at spent output profit ratio, also known as SOPR. Every time a token moves on chain, we can compare the price at which it moved last. This allows us to see if people are basically selling at a profit or a loss. SOPR is basically all of this happening across the market every single day in aggregate. So you're getting a full picture of what is happening on a given day. Are people selling at a profit or a loss? When you're looking at SOPR, you focus on the number 1. If it's above 1, that means coins moved today were sold at a profit. Below 1 means coins moved today were sold at a loss. The number gets very interesting and tells us a very different picture based off where we are in the market cycle. In bull market, SOP uses 1 as a floor. Dips towards break even attract buyers. The trend stays intact. In bear markets, SOPR uses 1 as a ceiling. When the market recovers break even, holders who've been sitting at a loss for a while choose to exit. Overhead supplies kills the recovery. You know those moments in crypto where the chart moves 15% and you don't understand why? No headlines, no macro, nothing. You can't figure it out. No obvious catalyst. That's called a liquidation cascade, and it's often caused by over leveraged longs getting wiped. When they get wiped and price drops, their positions are closed automatically. That forced selling pushes price down, and then this pushes price down further as other people are forced to sell. SOPR is great at capturing the aftermath of that. When you see SOPR spike deeply below 1, coins being sold at significant losses, you're often looking at forced selling, panic and liquidation combined. And those spikes have marked short-term exhaustion points across every cycle we've seen. Watching SOPR flip from a ceiling to a floor, that transition is one of the cleaner signals of a larger change from bear to bull. Okay, one of my favorites. Next up, we have realized and unrealized profit and loss. Zoom out from the daily behavior and you get 2 broader views of the market. The key word here to pay attention to is stress. Realized profit and loss, the actual gains and losses being locked in. Coins sold above their cost basis or sold below it generate real profit and loss. And that's what matters more than anything. Did people actually make money? Did they actually lose money? Because that makes the biggest difference imaginable when it comes to their real behavior. Spikes in realized profit tell you the market is taking money off the table. Spikes in realized losses tell you something more significant is happening. As we said before, it's probably capitulation. This is not people selling because the price is right. This is people selling because the pain becomes too much. Unrealized profit and loss is what sits on paper. The aggregate gain across the entire market hasn't actually been crystallized, but people are in a position where they're likely to take an action. People who are very up are getting to the stage they may be getting ready to sell, and the people who are down quite bad, depending on their circumstance, they may be in a position where they might be about to crack. In most cases, these are the short-term holders, as we said, whereas the long-term holders are a little steady, but since they're probably up anyway, they may decide it's probably time to take some chips off table. When unrealized loss reaches extreme levels, the market is collectively underwater. Either continued capitulation as holders give up, or a significant low as the last sellers exhaust themselves and supply dries up, which is right before we see a move up. The combined view is called the net unrealized profit and loss, or NUPL for short. This maps it on a spectrum. Euphoria at one end, capitulation on the other. And the extremes of the spectrum, every major cycle we've tracked align closely with the cycle turning. Not because on-chain data predicts price, but because extreme collective emotion, measurable through behavior, tends to precede reversals. And now, stay with me as we must break down profit and loss based on cohorts for the same reason we did cost basis, because these groups once again behave completely differently, and the divergence between them tells them where we are in the cycle. As we said, short-term holders, we're looking at recent market activity. Heavy losses mean they're most reactive. These guys are very likely to sell. They can't take the heat. They're very, very stressed, and things are getting very, very fragile. Long-term holders, the temperature of the market's backbone. They're probably not going to be influenced by the day-to-day moves, and they can deal with the pain. But even they have limits. When long-term holders' unrealized profit reaches extremes, they start to sell. Not panic selling, but slow, steady selling. And for those who do pay attention to on-chain, they tend to start following suit to front run the rest of the market. When you put all of this together, you can start to read the cycle as a whole. Early bull, long-term holders in profit from accumulation at lows. Short-term holders just entering. Cost basis near current price. Mid-bull, both groups in profit, momentum continues to build and new entrants arrive. Late bull, long-term holders start selling, short-term holders buying at elevated prices, often from the long-term holders, and that handoff is happening. Most people don't see it. Next thing you know, bear market. Short-term holders capitulate first, long-term holders hold, the cycle tends to reset. When you know where you are in that sequence, you know how to position. Not perfectly, but meaningfully better than those who are less informed. That's the power of understanding on-chain. Okay, last but not least, section 3, flows data. This is where most retail investors are flying blind because the inflows that actually move the markets aren't those within crypto itself, it's in the instruments most people aren't watching. I'm talking ETFs, I'm talking perpetual futures, and the total positioning of the derivative markets. If you don't understand these flows, you will always be surprised by moves that more informed investors saw coming a mile away. That's why we look at these every single week at Cryptonary. So let's look at these 3 metrics individually. First, ETF flows. The approval of Bitcoin ETFs changed the entire market. For the first time, serious institutional capital had a regulated vehicle to invest in Bitcoin. And the flows in and out of those ETFs are now one of the most powerful signals in the entire market. When ETF flows are strong and sustained, real money is entering the market. Not leverage, not speculation, actual capital buying actual Bitcoin. When ETF outflows increase, institutions are heavily reducing exposure, selling pressure from the largest capital-rich players in the entire market. A single strong day of inflows or outflows can represent tens of thousands of Bitcoin being bought or sold, and something that retail can never quite tap into. The key is to think of ETFs as massive whales, and when you're watching the inflows and outflows, you're basically imagining watch ETF flows the same way you'd watch massive Bitcoin whales, because that's exactly what they represent. The fact you're able to see what the biggest players in a market are doing is once again one of the biggest advantages crypto and on-chain in particular. Next, we have funding rates. Now, funding rates live in the perps market. This is where traders who are taking leveraged long or short positions without an expiry date. To keep perp prices anchored to actual prices, exchanges use something called a funding mechanism. When longs outnumber shorts, they must pay the shorters, and vice versa. Longs paying shorts equal a positive funding rate. When shorts dominate, it's also in reverse. Funding rates are a direct measurement of greed and fear in the market. More people longing, greedy. More people shorting, fearful. And even though less than the ETF market, derivatives drive significantly more volume than spot, especially in crypto. High positive funding means the market is crowded with leveraged long. People are feeling bullish, optimistic, and everyone believes price is going up. However, that creates fragility. Because remember when we said you have those moments where price crashes 15% and you have no idea why? One sharp move down and over leveraged longs get liquidated. Their positions are closed automatically. They're forced to sell. This pushes price down even further, triggers more liquidations, which pushes prices down further still, causes a massive cascade. You can think of it like this. The funding tells you how loaded the gun is. The price is just the trigger. In the opposite direction, if we see a deeply negative funding, it means people are very, very bearish. The market's crowded with shorts. That creates conditions for a short squeeze. A sudden move up forces these shorters to close their positions, adding buying pressure that further accelerates a rally. In both of these circumstances, these moves are often very violent, very fast, and they often go against convention. This is where we see short relief rallies and sharp pullbacks. A neutral funding means we're not extended in either direction. This is the healthiest environment for sustained growth. Markets that grind up slow and steady over time, no fragility. It means people are playing the game properly. If you have buyers and sellers in a market, typically that means demand is good, prices go up. People are not moving on optimism or emotions, they're thinking logically. Overall, I would say don't look at the funding rate as a measurement of direction, but it's a good sign that can tell you the health of the market. And depending on how healthy the market is and how fragile the market is, you're in a much better spot to know how to manage risk effectively. Now, onto open interest, also known as OI OI, open interest, is the total value of all outstanding futures contracts, both long and short, that haven't been settled. Basically, it's the total amount of borrowed money in the market. A rising open interest with rising prices is healthy. New money's building positions in the direction of the trend. A rising open interest with falling prices is dangerous. Either shorts are piling in aggressively, or longs who entered earlier are sitting in a loss and likely to sell. The system is under stress. A forced resolution becomes very, very likely. And as we know, forced resolutions are never good, as it's forced selling or forced closing, which just means increased fragility. It's going against what people actually want to do, and it means they got it wrong. And it pushes us towards more and more cascades in either direction. When we see a falling open interest, it means deleveraging. Positions closing, whether that voluntarily or not, and it causes a large flush. Honestly, this is where the market is most healthy. Sure, a lot of people get wrecked on the way there, but less leverage means less fragility. The next move tends to be a real one based on reality. The combination of open interest and funding rates is what matters most. High OI, high positive funding, the market's dangerously long. It's a crowded trade, a massive red flag. You need to protect your position. A high OI, deeply negative funding, the market is dangerously short. A squeeze is very possible. An asymmetric setup for those positioned correctly. Good for the traders, not ideal for the investors. On the other hand, low OI, neutral funding, this is clean. The market can move freely. Moves in the environment tend to be meaningful and sustainable, not whipsawing back and forth. It's critical you read OI and funding together, not in isolation, as alone they don't give you the complete picture. Okay, that was a lot. 12 metrics across 3 cohorts, and if you're sitting there thinking there's no way I'm going to be able to remember all of that, 12 metrics was too much, you don't have to. I gave you those so you can see the bigger picture, and as long as you can see the bigger picture, you'll be able to outperform time and time again. Let's take a look at a real life example. It's late 2022. Bitcoin has been falling for most of the year. Sentiment is at all-time lows. Every other headline is crypto's dead, and this hack, and this exchange closes down, and everyone's crapping themselves. People are either paralyzed or they're selling, and the price is dropping sharply. But if you weren't looking at the headlines and you were actually looking at the data underneath it, you'd be in a very different position, and you certainly wouldn't be panicking. This is what we saw. Short-term holder cost basis was well above spot. Recent buyers were deeply underwater. MVRV was below 1. SOPR was below 1. Coins being sold were being sold at a loss. Realized losses were spiking. NUPL was in the capitulation zone. Open interest had been flushing for weeks. Funding rates had gone deeply negative and were recovering towards neutral. In short, the terrible time had passed, right? This was now not the time to start dumping your tokens. That time had passed. We were getting set up for a positive spin. While everyone else was asking Twitter what to do, you were looking at the market and seeing that weak hands had already sold. Coins had moved from anxious to patient hand. When the derivatives market had already been cleaned out, you had a framework, and that framework was telling you this looks like the bottom is in. So you sized in methodically over time. You didn't rush. 18 months later, Bitcoin was at an all-time high after a slow grind up. Now, everyone around you was euphoric. The group chats are popping off, crypto's trending on X, new money is flooding in, presidential candidates are trying to show you crypto to win your vote, and everyone says that the narrative of this cycle is different. But now, the data's telling you a very different story. Long-term holder, MVRV, is at historical highs. Long-term holders are sitting on massive unrealized gains and starting to sell. NUPL is in euphoria territory. Open interest at record levels, everyone's looking to long. Funding rates are strongly positive. ETF inflows are massive and sustained, and every metric in the system is flashing the same thing. The market's priced for perfection. Everyone's long, everyone's in profit. But you, because you understand on-chain, are slowly taking chips off the table. You're moving some to profit safely. And then when the inevitable correction came, hard and fast, and most people got wrecked, the way it always does, you were prepared. That's the framework. One complete picture of what's actually driving the market underneath the surface. Look, most people in crypto will never develop this. Not because it's too difficult, but because they'll never slow down enough to try. They'll stay on charts and they'll stay doom scrolling X because that's easy. That's in their comfort zone. That's familiar. But you're different. You made a change. You spent 45 minutes watching this video to make sure you understood things at a deeper level, and that's why you're going to succeed. You've got the macro layer from our masterclass, the structural layer from our TA Masterclass, and now you have the on-chain mechanics layer from this. Most retail investors have none of this. You have all three, and that's why you're going to move forward with confidence. But knowing the framework is only step one. Applying it in real time, week after week, across changing market conditions is where your edge will compound. And sure, you can do this. But if you can't and you need extra assistance, that's where Cryptonary comes in. Every week we publish on-chain analysis. The metrics that we covered today apply to live market conditions, updated and contextualized by the team that has been reading this data across multiple cycles. If you want that, link is in the description. If you're managing a larger portfolio and want something beyond the research, you want something one-to-one where you work with me and the team, that's what we do in a circle. That link is also in the description. And you know what? If you don't feel you're quite there, stay close, subscribe, and I'll see you in the next one.